I start my presentation with the usual disclaimer about forward-looking statements that this presentation could have, uh, which um, which could change with time and future developments. Uh, the company has done well, and I'm happy to report that in weathering the challenges that the country is facing in reviving the stalled engines of growth, namely rural demand and private investment. Hopefully, with good monsoons and passage of economic and policy reforms, both the country and the company is hopefully headed for better times. On that note of optimism, let me turn around to how we have performed as a group. Uh, the company has done well on most of the parameters that it is measured for its performance. Uh, the orders have increased by 14%, and these are comparable numbers to the first quarter numbers of the previous year. The order book consequently has grown up by 8%. Revenues have increased by 9.1%. EBITDA has gone up by 16%, and profit after tax has gone up by 46%. It's important to bear in mind that we are reporting the financial numbers prepared based on the new accounting standards, Ind AS as it is called. And we have also taken effort to convert and restate the numbers of the previous year's first quarter on Ind AS basis, and both these have been reviewed by the auditors. Looking at the parameters individually, the company as a group, among all its portfolio of businesses, have recorded orders worth 29,700 crores, which is a 14% growth over the 26,000 crores that we reported in quarter one of the previous year. Much of the growth has been on account of the order win that we've had in hydrocarbon business in the Middle East, a large order that we received from Saudi Arabia. And in contrast to the 69% growth in the order inflow of the international business, the order inflow of the domestic business has declined by 9%. This is on account of much of the projects that we were targeting in the domestic markets have been deferred for awarding, and they did not move adequately in quarter one. And consequently, the infrastructure sector, which provides the bulk of our order inflow, did not report any growth in terms of fresh orders. And that overall impacts the domestic order procurement of the company. The order book, however, has grown to 2,57,000 crores, which is an 8% growth over the previous year. And the international orders account for 29% of the total order book that we have as of 30th June 2016. The order book is as a result of 40% of the orders for the current quarter coming in from infrastructure sector. The 29,700 crores is largely contributed by the 11,000 odd crores that we have picked up from the infrastructure sector. Hydrocarbon sector has joined the party in the quarter with this large order that I spoke to you about, and they account for 27% of the total order inflow for the quarter. All the services business, the information technology, the technology services, the financial services, all of them have performed well during the quarter, and they account for 19% share of the order inflow. Just for clarification, the revenue that are earned by these businesses are taken in as orders for the purpose of accounting completion. The order book of 2,57,000 crores has bulk of it from infrastructure sector. 74% of the order book is on account of the work that we need to do in the area of infrastructure. And this reflects the thrust and the focus of the country as well. The regions that we work in, India, Middle East, and the neighboring regions, have taken upon themselves to develop infrastructure segment. Consequently, the infrastructure sector bags the substantial portion of the order backlog. We have 21,500 crores of orders to be executed in the hydrocarbon sector, and we have 16,900 crores of work to be executed in the power sector. the rest of the sectors account for the balance in the order book. Shifting to performance of the company in terms of revenues and profits, the revenue from operations grew by 9%. For the quarter in question, we had revenues of 218 billion rupees, and 76 billion of this 218 billion rupees came in from international contracts that we are executing. That takes the share of international revenue to total revenue to 35%, up from the 32% of the previous year's first quarter. Thanks to the global commodity prices and the general slowdown, the input costs have remained pretty stable, and hence there is no significant increase in the manufacturing, construction and operating expenditure of the company, and the amount of 136 billion reflects the current level of activity for projects under execution. The finance cost of the financial services is nothing but the raw material that the financial services business use, and hence they are stated as a line distinct from the interest cost that we run for all the funds that we employ. The finance cost of the financial services business and the finance lease activities are at 13.22 billion, 11% growth over the previous year's first quarter numbers. Staff cost at 34.2 billion is up 9%. It reflects the staff augmentation that we have for executing the jobs that are under progress and the staff augmentation in the services business. The fact that nearly 35% of our revenues come from international business also means that much of the staff incrementally are also those added in those geographies. Sales, administration and other expenses at 15.74 billion rupees is up 16% as compared to the similar line item for the previous quarter. And the increase that you see is largely on account of the provisioning that we are required to make for non-performing assets for the financial services business and the other recoverable business for the rest of the portfolio of the businesses. Might be of interest for you to note that the new accounting standards Ind AS enables us to make provisions for anticipated credit losses, and that was not the case until the introduction of these new standards. So consequently, the provisioning that we had to do to comply with these accounting standards have also contributed to the increase of 16% that you see in the sales and administration expenses. The total operating expenditure of the company for the quarter at 199 billion rupees is up 8%, 1% lower than the increase in revenue at 9%. Consequently, EBITDA at 19.05 billion rupees is up by 16%, and the EBITDA margins have increased by 50 basis points from 8.2% to 8.7%. The interest expenses that the group is incurring on account of the funds that it employs for its various businesses have reduced by 13% from 3.89 billion rupees to 3.37 billion rupees. It's reflective of the level of borrowings that we run and the credit conditions that we operate in. We do believe that the interest rates could tend to remain soft given better than past monsoons, and hence the relief that it could provide on the inflationary lines. Depreciation remains stable at 4.65 billion rupees. Other income has increased by 7% at 3.02 billion rupees, largely reflecting the gains that we've had from managing the short-term money as part of our treasury operations all across the group. After providing for taxes, the net profit after taxes at 6.1 billion rupees is up by 46% as compared to 4.19 of the previous year. I once again wish to remind you that the numbers of the previous year's first quarter have been restated to be in line with the new accounting standards with which the new current quarter is getting reported. We have 9 segments. We historically used to have 10 segments, but with the shrinkage of business in the metallurgical and material handling business, the thresholds for segment reporting is not met, and consequently material handling and metallurgical business have been classified as other segment, but the rest of the segments are as you have seen in the past. Taking each of these segments for some details, infrastructure segment, which is our largest segment, has seen revenue growth of 9%, quite similar to the growth of the group revenue. The revenue earned by the infrastructure segment is at 90.67 billion rupees, and 30.32 billion of this is on account of international revenues, the jobs that we execute for the infrastructure segment in overseas markets. The growth of the international revenue, in contrast to the overall growth of revenue at 9%, is 20%. The EBITDA margins have increased for this large segment by 30 basis points from 8.9% to 9.2%. Moving on to power segment, the jobs under executions have progressed well during the quarter, and that is reflected from the income from the projects under execution moving up from 10.78 billion rupees to 17.22 billion rupees, a 60% growth. With the progress on the Bangladesh gas orders that we have won, the share of international revenues have increased 3 times from 1.06 billion rupees to 3.45 billion rupees. Consequently, the EBITDA margin have increased from 1.2% to 5.8% for the quarter in question. I must once again remind that the project businesses, the margins and the orders and the revenues do not accrue uniformly, and there would be quarterly volatility which will ultimately level out in line with our guidance for the end of the year. Hydrocarbon segment has seen a flat revenue of 21 billion rupees as compared to the quarter one of the previous year. This is largely reflective of the late accretion to the order book of hydrocarbon segment in the previous year. We do believe with the progress on those jobs on hand, we should be able to see better growth on hydrocarbon revenues going forward. Nearly 50% of the revenues that we get from hydrocarbon segment is on the international markets. Much of it is in the Middle East, and hence out of the 21 billion rupees, 10 billion rupees are on account of international contracts that we are executing. The margins have remained stable because of the mix of the jobs, as well as last of the legacy projects which has caused us a lot of pain in the past years is coming to an end, and hence we find that going forward the margins between the second and the fourth quarter of the year would see an upward tick from the current 2% that you see for the quarter one. Heavy engineering business, which has process plants and nuclear equipments as well as defense, has seen a 6% growth in its revenue at 6.53 billion rupees as compared to 6.19 of quarter one of the previous year. Like hydrocarbon business, we do export a fair bit to international markets, and hence almost a third of the revenues of the heavy engineering segment is for jobs that we execute against overseas orders. The international revenues for the quarter is at 2.6 billion rupees, up 22% from the 2.1 billion that we have. If you recall, in the quarter one of the previous years, we had to absorb delivery charges, late delivery charges and liquidated damages on some of the contracts that we were executing beyond the stipulated contractual timeline, and hence the margins of the first quarter of the previous year had taken a knock. But with the current quarter, all the projects going on course and on schedule, the margins have improved from 8.9 to 14.9, and it is beginning to resemble more of the margins spectrum that heavy engineering business provides. Electrical and automation business, the overall industry, switchgear industry, is reflecting the very weak industrial demand, and on the back of 2 failed monsoons, very poor offtake in the agricultural sector. The slowdown in the real estate sector have also contributed to the business fortunes of the electrical and automation business. The revenues of the electrical and automation business at 9.31 billion rupees is lower by 3% as compared to the revenue of the previous year, first quarter of the previous year. It is important to note here that the standard product business has done well within the portfolio of electrical business. It is the project business that has lagged, causing the lag in overall decline in the revenues. The margins, however, on the back of improved performance by the standard product business is improved from 5.8% to 7.8%. Coming to technology services and information technology, as legal entities, these are 2 different entities, but for segment purposes, for the purposes of reporting at the group level, they reflect similar business profile, risk and reward wise. Consequently, they are clubbed together as a single segment, and we call it as information technology and technology services. The revenues have grown by 15% in this segment, from 20 billion rupees to 23.53 billion rupees. The business have also done well to get rid of accounts which are unproductive, improve their operational excellence, improve their resource optimization. Consequently, we see a healthy increase in their EBITDA margin from 18.4% to 21.9%. And we do believe that these improvements would continue to stick with the business in terms of margins.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.